and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at a couple beaten down large cap stocks to consider buying for possible really long-term upside. And the two stocks we're looking at today are Enphase Energy and Public Storage. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for looking at some of our services, portfolios, and more. And before we jump into the two stocks, it's worth just kind of digging into a little bit of what's going on with the market, just to give a better sense of maybe why we're looking at these two stocks in particular. So the S&P 500 and the NASDAQ slipped to start the holiday shortened week. So that was on Tuesday and Wednesday. And then we saw the market open lower on Thursday. But then through midday on Thursday, we saw the bulls fight back. So the bulls are still trying to hold that ground. And most investors, though, are starting to think that a nice pullback, certainly from these mega cap tech names, would be nice. And I tend to agree that a downturn and maybe some sideways weeks from those mega cap tech names to help shake off some of that froth would be nice, especially if the alternative is sending things into hyperdrive and then only to plummet later. I don't, however, agree necessarily with the headlines that are comparing the recent boom to the dot-com bubble, because the numbers really don't support that. Of course, though, not every current artificial intelligence stock is going to be a game changer, but NVIDIA and Tesla and Apple and all these other mid-cap names that have driven the rally are proven and deeply embedded into the economy, and they're going to continue to grow. Maybe their valuations won't reach the levels that some are at, but even their valuations aren't that stretched. Even if you look at NVIDIA, its PEG ratio, so that factors in growth, is not high at all. So that just shows how much growth they're expecting. And this is analyst estimates going up. So these, oh my gosh, these are crazy dot-com era stocks that are just overinflated. It's kind of hard to say that for these, as I said, chip companies and Tesla, that's at the forefront of industries that are going to help fuel this wider kind of tech mega cycle. So those stories might not be that relevant at the moment. That said, though, it would be shocking if you see a pullback from these mega cap tech names as people just decide to take profit. I mean, some of these stocks are up over 100%. Lots of these names are up over 40% so far in 2023. And so with this in mind, we could start to pay attention to that 4,300 level for the S&P 500, which might be a line that the bulls have to hold in the coming days and weeks, because that marked the high following that big summer 2022 rally. So that could be a line in the sand to kind of pay attention to. That said, even if some of the wider indexes do indeed slip with the mega cap tech pullback, that could be happening. We'll see. There is an idea that more and more companies are starting to participate in the rally as more money comes in off the sidelines. So this is why we're taking a look at two of these stocks we're looking at today, is because so many great names in the S&P 500 that operate proven, established businesses that are going to be around in the coming years and possibly coming decades have not participated in the rally and are still trading way below their highs. And there's a lot of these companies, as I said, because mega cap tech has driven so much of the run, that people have kind of ignored up until now for 2023. So we're going to look at two of those names today that are maybe worth buying. And we're going to get into some of the levels that maybe you want to hold off a little bit if you're paying attention super to technical levels. But if you're a long-term investor, these two names we're talking about today might be worth considering, because it's always worth remembering that when everyone wants to buy stocks, it's maybe not the best. So when everyone's trying to clamor for NVIDIA and Apple and Meta, you might want to hold off and instead choose to buy stocks that seemingly no one wants to buy at the moment. That's kind of a good rule of thumb for longer term investors. So the first stock we're looking at is Enphase Energy, which trades in the ticker ENPH. Enphase is a solar energy firm that's thrived as one of the largest makers of microinverters for solar panels and battery systems. The stock has, though, been hit really hard recently alongside fellow inverter stock SolarEdge. And now might be a time kind of for investors for longer term outlooks to consider the stock. So let's see why. Inverters are vital high-tech components in the solar ecosystem because they convert the DC power that solar panels produce into the AC power used in our homes and businesses. Enphase offers a portfolio of tons of growth runway, given how important inverters are within the wider solar industry that's still it's now established, but it's still going to grow for years and years as countries like the U.S. and many other rich nations go all in on renewable energy, with solar playing a big part. And its microinverters are designed to work one for one with each individual solar panel to help generate more consistent power, and they enable energy production to continue even if one panel fails, unlike some of the string or central inverter rivals. And its battery storage segment's also growing as well. And it has hundreds of patents and patent filings covering various renewable energy tech. So that's worth just mentioning. In terms of its growth has been massive as more and more people and companies are investing in solar panels. So it climbed from $300 million in revenue in 2018 to $2.3 billion last year in 2022. The company topped our EPS estimates once again in late April, but it did provide downbeat guidance that then sent the stock tumbling. So at the time, Enphase mentioned, and this is in late April, that rising interest rates and new rules, specifically in California, were kind of casting a shadow over the rooftop solar growth prospects in the near term. But overall, as I mentioned, the wider solar energy push is still going to be going in full force for the coming decades in the U.S. and beyond. So the company, though, did say its sales growth could be slow in the coming periods because of weaker demand in the U.S. in the near term. That said, its overall earnings revisions didn't get dented too much if you look at just a wider scale from over the last 5 years. Its outlook for 2023 and 2024 has held up rather well. So despite the little bit of downbeat sales guidance, its earnings revisions outlook still looks pretty solid. And it's crushed our estimates in the last 4 quarters alone. It's crushed by about 20% on average. So solid bottom line beats. And then if we look, as I mentioned, it has had huge revenue growth. It went from around $300 million in 2018. It then did 98% growth in 2019, 24% growth in 2020, 78% growth in 2021, and then another nearly 70% growth last year. So just a massive string of revenue growth. In looking ahead, we're calling for another 33% growth this year on top of that booming stretch. So the company's set to go from 2.3 billion all the way up to 3.1 billion. So adding nearly $800 million to the top line. And then we're calling for another 25% revenue growth next year to get all the way up to about 3.9 billion. So really impressive growth, even though the year-over-year growth rates are slowing as the numbers get a little bit more mind-boggling. And then on the bottom line, we're calling for 20% adjusted earnings growth this year to get up to about $5.55 per share, and then another 35% adjusted earnings growth next year. So as I said, despite that big fall after they reported some downbeat near-term guidance, its overall outlook still looks really strong. So then in terms of the stock price movement, the stock soared from around $3 per share 5 years ago to well over $300 last year. The stock's still up about 2,200% in the past 5 years, but it's now roughly sideways over the last 2 years, and it's currently trading 50% below its highs and nearly 60% under its average Zacks price target. The last time I looked, it was down on Thursday at around $164 per share. And despite all of that, Wall Street's still pretty high. So in terms of our Zacks brokerage recommendations, of the 27 brokerage recommendations that we have, 19 are still at strong buys, with another buy, 6 holds, and only 1 sell out of 27 brokerage recommendations. So despite the near-term headwinds, the stock is still in a strong position and liked by Wall Street. As I mentioned, or sort of alluded to up top, its technical levels might be a little bit worrisome. It's trading below both its 50-day and 200-day moving averages. Zooming out, though, the stock is now approaching its 200-week moving average for the first time in around 5 years. So if it does find support there, Enphase could be poised to break out. So anyone who's watching those levels, if you're thinking about buying the stock, you might want to wait to see how it does react in the coming days, because it's getting pretty close to those levels. And if it does fall through, maybe it's in for even more of a downturn. But if you're a long-term investor who can just hold their nose and buy, it's certainly worth considering. And then when we see, in terms of its value, it's now trading at a 45% discount to its 5-year median and 75% below its peaks at 33 times forward 12-month earnings. And then its PEG ratio, which factors in growth, is at 1.3 versus the S&P 500. It's 1.7, so trading at a discount to the broader market, even though it's soared over the last 5 years. And remember, as I've mentioned too, that's just worth kind of hammering home, that some of the best times to buy stocks is when seemingly no one else does. This stock, it's getting hammered and hammered, even though it's growth on both the top and bottom line in an industry that's going to continue to grow, even if it faces some near-term setbacks, might be worth considering, as everyone else is clamoring for all these stocks that are already up 100 or more percent so far this year. And then the other name we're going to talk about is a much different company that operates a much different business, more stable, less growth heavy focus, but we'll see that its growth has been pretty impressive, and that is Public Storage, which trades in the ticker PSA. So Public Storage is one of the largest owners, operators, and developers of self-storage facilities in the U.S. It currently operates nearly 3,000 facilities in the U.S., and it serves almost 2 million customers. So PSA, it's worth noting, is a REIT, and its business has been gaining serious momentum for years as Americans continue to buy just more and more stuff, big and small. I don't know if anyone personally owns a storage space, but I'm sure they know someone who has. Either some people have multiple storage spaces, some people rent them for college, various things. And whether you live in a big city or a rural area, I'm sure it's not too hard to spot at least a sign or for a self-storage facility or the storage facilities themselves. They're everywhere. Public Storage grew its revenue at a pretty steadily impressive pace for the last 20 plus years, including a nice string of revenue growth. It did about 17% revenue growth in 2021, and then 22% growth in 2022. A lot of this was COVID related. People are just buying things all over the place. And now we're calling for another 7.4% revenue growth in 2023, and then another 5.2% in 2024, which actually marks better growth than the company was doing in the few years prior to that COVID boom. So continued impressive top line growth after 2 really strong years of kind of difficult to compete against top line growth. And then in terms of its adjusted FFO, which is essentially earnings for REITs, you can just think of it as adjusted earnings. We're calling for its bottom line to climb by about 5% during both years. The company's bottom line revisions have stagnated recently to help it grab a Zacks Rank 3 hold. And I should mention, I don't know if I mentioned, Enphase is also a Zacks Rank number 3 hold at the moment. So back to PSA though. PSA is trying to make a big splash. We have not had many updates on this, but they had they reached out with an unsolicited offer to buy a rival in the self-storage space, Life Storage, in an all-stock deal. The company rejected that, and it seems like that's not going to go through, but just to put it in perspective, the company is trying to grow. We'll see what happens. And once again, all of those growth figures were based on the company not acquiring it since that offer, that unsolicited offer, was rejected. But worth just noting that the company is trying to expand, and that could be a possibility in, say, the next couple of years. The company also flexed its financial firepower when it lifted its dividend by 50% back in February. Its yield is currently about 4.2% at the moment. And this is all despite the fact that the stock has surged about 735% over the past 20 years to crush the industry it's in, its Zacks industry, and the S&P 500. And Public Storage was looking really strong over the last 5 years until it took a dive last spring. So the stock is now trading 33% below its highs at around, the last time I looked, it was trading at around $283 per share, which actually sits now 20% below its average Zacks price target, so gives it plenty of upside there. And then like Enphase, though, it's trading below both its 50-day and 200-day moving averages and below its 50-week moving average like Enphase. So the next level of support is that 200-week moving average, which, just like Enphase, if you want to wait and see how it interacts with that average, and if they both do find support, they could be poised to break out. And then in terms of its valuation, the downturn coupled with its solid earnings growth has it trading at 20% below its 10-year median and 40% off its highs at around 16.9 times forward 12-month earnings. So some investors might want to wait for PSA and Enphase to bounce back before they jump in. But You might want to consider maybe nibbling at them if you're at all impressed with their long-term business outlooks in two very different areas of the economy, though, that should both be able to thrive, say, a decade from now. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.